Nice to meet you.
All right. Welcome everyone to the TIE Innovator webinar series. I'm Jackson Wyarev. I'm Director of Protocol Sales at the TIE. And today I'm joined by some awesome guests. We got David Markley, the Chief Operating Officer at YieldPoint, Mike DeMello, Head of Finance and Strategy at RAC, and Philippe Engels, BD Partnerships and Strategy at Avantgarde. So today we're going to focus on the search for sustainable on-chain yield. There's certainly no shortage of yield opportunities in digital assets, but the harder question, particularly for institutions, is understanding where those returns actually come from and whether they can persist. So we're going to unpack how yield strategies are constructed and curated, how institutions can distinguish durable economic yield from temporary incentives, and what standards around risk, liquidity, custody, and transparency need to exist before institutional capital can participate at scale. Before we begin, just a quick disclaimer. The information contained in this webinar is for informational purposes only and is not intended as investment, legal, tax, or financial advice. So let's get this kicked off. We'll start with introductions. So I'd like to frame this through the lens of today's discussion. So could each of you briefly introduce yourself and your organization, and then answer a simple question. Who ultimately pays the yield in your product? What are they paying for? And why should that demand persist? Mike, let's maybe start with you, and then we can go around.
Right on. Well, good morning, good afternoon to everyone. Thanks for joining. Thanks to the TIE for hosting this. My name is Mike DeMello, Chief Strategy Officer at Real Asset Acquisition Corp. We're a real world asset protocol, like a liquidity infrastructure. The whole idea that we have here at RAC is to introduce like a different collateral type than what's being used in open finance now. We have collateral that is highly correlated. So if the main assets that are being utilized to borrow now, if they move, it tends to move everything. So if you insert like real world assets like gold, real estate, it adds a whole uncorrelated nature to the project. And at the end of the day, when you think about this, the problems that are functioning in the sense of in open finance, like liquidity provision, rewards harvesting, and revenue. Because at the end of the day, Jackson, if you're going to distribute yield, it's got to come from some manufactured source or structured source or revenue source.
100%. David, you want to jump in with an introduction on YieldPoint?
Yeah, happy to. So Jackson, thanks again. As you framed up, I'm David Markley, Chief Operating Officer of YieldPoint. YieldPoint is the team behind a token called Unity, which is a market neutral synthetic dollar, and Unity, which is its yield bearing version. Fundamentally, the people who pay our yield are leverage traders in the perpetual futures market. So under the hood, the backing collateral for Unity is we hold spot, crypto, and short an equal notional amount in the perpetuals market. And so when longs pay funding to shorts, they're effectively paying the holders of Unity. And what they're buying, so why do people engage in this marketplace, is that these traders, they want leverage, right? And crypto historically has had structural demand for long leverage, and there's been a limited balance sheet that's been able or willing to provide that leverage. And so that's the demand. It's persistent. It'll continue to persist as long as there's speculation and as long as traditional balance sheets basically can't freely arbitrage it away. And so critically, as Mike pointed out, this is collateral in this open financial system that is decoupled from DeFi TVL. It's not premised based on token always go up and therefore I can extract or harvest my yield. It's a structural force that exists within the crypto walls. So I'll leave it there. A lot to unpack. Philippe, over to you.
All right. So my name is Philippe. I am head of PD at Avantgarde. Avantgarde is an asset manager focusing on DeFi. We've been around since 2016. Started on strategy since 2019. We are now focusing heavily on RWA strategies, so how we can leverage the opportunities that arise in the space. So who the payers are. We are heavily focusing on lending markets, so meaning that the borrowers in those lending markets are the ones that pay the yield. We are also running some treasuries for DAOs in the space. We're running covered calls strategies. So there are some OTC desks that pay the premiums on the options. So there is also a real demand on the other side of the trade, and those premiums go back into our on-chain strategies. And what I mentioned now, real-world asset that bring effectively real-world yield to the blockchain. And there are nice plays now with which we can exploit for different types of strategy, including looping and other DeFi native strategies that are easier to execute on chain.
Yeah, thank you all for those great introductions. So let's keep the conversation moving. Let's talk about what makes yield sustainable. So question for everyone. Whoever wants to jump in first, feel free, and we'll go around. But essentially, I think we've established where the return comes from. But now, what makes a yield source sustainable enough for institutional underwriting? And what's one red flag that should disqualify an otherwise attractive APY? So in other words, is there a level of APY itself where it actually becomes a red flag?
Jackson, if I may, because I think the gentleman did a great job at actually positioning the three protocols. So it's like you either manufacture it by providing a structured product, right? If you're providing a service, like as David said, leveraging, there's got to be some fee that is involved with it. So you can harvest the rewards that way. Treasuries is another way, because that is where you're getting your interest from just buying these bills. Structured products like a covered call strategy, which is an advanced strategy, but again, you can manufacture a target yield return. In our case, we're actually tapping into an existing ecosystem in open finance on the decentralized side that has a business already. And by tapping into that, you can then create yield from that ecosystem. So I think it's there's a lot to uncover each of those buckets, because our colleagues here do great work at making sure they do the best they can within that bucket, right? Like, I'd love to hear more about David's basis trade with yield point, because I think it would come into the side of how you would generate yield using that strategy, because that's pretty sophisticated strategy.
I'm happy to pick up the baton here. So yeah, Mike, I think you framed it up well, which is, there's kind of this this bifurcation. There is yield that you tokenize and then bring that yield on chain, right? So whether it's returns from real estate or otherwise, and then just bringing those into the open financial infrastructure, or it's what I would call crypto native yield, which is there's leverage, demand, there are fees being paid within this open financial ecosystem, and then how do you basically capture that fee extraction? And so from the point of yield point, we clearly fall into that latter category. Funding is paid by traders buying leverage. In Philippe's case, lending yield is paid by borrowers, right? And that's what fundamentally survives underwriting. The industry, and I've had the privilege of being a part of it since, several years now, since 2017. We've spent a long time dressing up marketing spend as yield, where it's this ephemeral, come one, come all, get 70% APY. And then the second the marketing budget dries up, the yield evaporates. that's not underwritable, right? So I think that's where this tension fundamentally comes from, is that there's a lot of marketing spend, customer acquisition spend that falls out of these L1s trying to do land grab, user acquisition, port applications over. But then the second that marketing spend evaporates, well, then like what's left? And what you have is what we just went through, which is the leverage, the lending, and then the fees, whether you're a DEX or some other protocol that's in the middle of those transactions. And so that I think is what survives institutional underwriting. And then like the flag is exactly as you articulated the question, right? It's who pays for it, what are they paying for, and would they continue to pay for it if Mike, Philippe, and I didn't exist? And if the answer to those three things is yes, there's probably a good business.
Yeah. And maybe one thing which the blockchain, I come from infra, from the Oracle side and from data. And one point which the blockchain actually makes and maybe easier to underwrite is the opacity problem. So any strategies that are on-chain are fully transparent, right? So most of the time you can see how the strategies are executed, at least in our case, because we've been running treasuries for DAOs. They wanted to have full transparency on everything that we do. So all of the transactions that we've been executing are visible on chain. So, but if there is no opacity into where the yield comes from, how the strategy is executed, this would also be a problem which big institutions cannot easily underwrite.
Yeah, and so I think both David and Philippe, you guys touched on underwriting. So let's kind of dive into that topic a little bit more, because institutions aren't evaluating on-chain yield in a vacuum. They're comparing it with opportunities they can access elsewhere. So I guess the question is, how should an allocator compare the net return after considering things like fees, hedging, execution costs, expected losses and incentives, with the closest off-chain benchmark? And what additional premiums should they demand for taking the on-chain risk? So this is open to everyone, if whoever wants to jump in and grab that.
Yeah, I'm happy to start here. We so the on-chain kind of risk-free rate, as it were, is the tokenized money market funds, right? So if you compare our yields to BUIDL, that tends to be where most allocators start if you're looking purely on-chain. If you're looking off-chain, CME basis trade, specifically around Bitcoin, is probably like the closest parallel between the traditional way of accessing this and then the more, I'd say, frontier way of accessing it, the way that we do at Yield Point. And so really to compare those two, as you mentioned, execution costs, hedging drag, any incentives, because there are protocols that add additional incentives on top and extra kickers. It's really what's the spread of a treasury desk earns doing the CME basis trade or buying treasuries versus deploying capital on chain with us. Historically, Yield Point's delivered anywhere between 2 to 3 times the institutional comp set. And so we think that is attractive enough. Our depositors certainly think that that's attractive enough on a risk-adjusted basis to continue to use the product. And what they're fundamentally underwriting when they use a Yield Point versus doing something off-chain is smart contract risk, custody and counterparty arrangement risk, and then venue concentration. And so those are the things that we work and we've architected our system to minimize and mitigate. But fundamentally, that is the delta between doing this like a CME basis trade versus kind of the on-chain frontier set of perpetual futures that Yield Point wraps. And so that's what justifies the 2 to 3x premium. And we think a lot of our institutional counterparties, they ultimately get comfortable with that when they see that they can double or triple the return on their cash.
Yeah. And I will pick it up here. There are, of course, extra risk premiums that need to be paid because of on-chain execution. There are different types of risks that the depositors and allocators take that are not available in the traditional finance world. So smart contract risk, we've seen a number of exploits, shaking the space over time, especially over the last 12 months. Then there is also liquidity and exit risk in the markets, and infra risk, which can come from Oracle feeds that can be exploited. So there are a number of additional risk parameters that need to be priced, into the as premiums for it to be worth their while. So an exact number is difficult to articulate here, but there are all of those risks that need to be taken into consideration. And if these don't add up and you get just a bit above T-bill rates, then rather go T-bill, because it's the safer route, right? So the yield needs to be consequent based on the risk profile of either the strategy or the protocols that you're using. So yeah, that needs to be taken into account.
And just to add to what Philippe and David said, Jackson, like the environment that we've been in, say, to Philippe's reference, the last 12 months, we've been having heavy competition with the yield curve. Even before the call we were talking about, there's a whole bunch of action, and the yield curve's kind of like, it went from being flat to inverted. And open finance had a ton of money coming in because there was a massive yield differential, right? The carry trade, quote unquote, that has been existing in traditional finance between currencies for forever was happening in open finance. But that's when you had a lower rate environment, a flatter curve. Now, the curve's like elevated. It's sloping. You're getting paid 5% for, I think it's 470 for the 10-year. So it's like, wow, that hurdle rate just got a bit more competitive in open finance, right? So yeah, I think that there's still opportunity in the manufactured or structured side of open finance. Diversification. You can, instead of being single focused, you could have, kind of a core and explore approach to total yield approach, where you have like a core strategy, like a yield point or an avant-garde, and then you satellite it with some higher yielding strategies out there.
Yeah, and Mike, we could dive deeper into that, because with RAC, you're combining real-world asset cash flows with on-chain lending and liquidity. So how do those different return streams behave across market cycles, and which one is designed to anchor returns when DeFi incentives or crypto native borrowing demand potentially weakens?
Yeah, thanks. Good question. I mean, we still have part of our system, RAC Lend, to be released, which is where you would be able to take our collateral tokens. Like, for example, we tokenized real estate in March, and so these are fully paid rental properties generating income, and this income is in the real world, like it's rental income, and that becomes a new source. I think David mentioned you have the open finance circulating supply, but you need new supply, right, to come into the system to actually be net positive. Real estate tends to be uncorrelated to crypto, and it's more attached and sensitive to interest rates, and again, from a diversification perspective and collateral type in open finance, there isn't really that many real estate tokens to borrow against. So we're kind of, for us, we think it's a bit of an innovation to have our real estate token as one of the assets that you'll be able to borrow in RAC Lend. And again, it's all about what's the cost of borrowing, what is your, like, where do you go with the source proceeds, like if you're doing this. But we at least know there's a fixed amount of revenue coming from the assets. I hope that answers the question, Jackson.
It does. And I think to follow up, like, how correlated would you say these sources become during actual market stress?
Well, from the rental property, I guess it would be tied to the ability for the folks to continue to pay. I mean, we've done a lot of due diligence, and we actually partner with a third-party vendor that does all that property management and due diligence and stuff. Crypto assets, again, they run at their own tune. They have their own heartbeat, their own supply dynamics. We actually think that's a positive for our ecosystem, because you can attach yourself to different types of revenue streams and different types of assets.
Yeah. And now I want to jump back to David, because David, as Unity, which again is your synthetic dollar, expands beyond Bitcoin and Ethereum across additional assets and venues, presumably that increases the number of opportunities available to generate return. So how does that broaden the opportunity set? And what new liquidity, execution, and counterparty risks come with that expansion?
Yeah. Yes. So to frame it up, fundamentally, the wave that YieldPoint is riding is that we believe that perpetual futures are going to slowly consume every single financial asset, over time, right? They're fundamentally really good at concentrating liquidity, which means you have better price execution, and fundamentally really good at offering leverage, which you don't have to do exotic options, contract pricing or rolling monthly futures. You can just see what the price is for the perp, and then you can decide whether or not you want to, basically buy that leverage in the market at a point in time. And so as a byproduct of that, we think it just makes these financial instruments much more accessible, which means there will be more volume and more trading over time. How does that relate to Unity? Well, Unity is fundamentally packaging exposure to the perpetual futures market, right? And so as you mentioned, Jackson, BTC and ETH are crowded fairly substantially, right? I mentioned the CME futures trade as one way of being able to gain access to that type of yield. And so as a result, the yields there have been compressed. They've kind of become the base rate in crypto, right? And they're, to Mike's earlier point, they're not so dissimilar from treasury rates. And so you really have to squint as, hey, am I being adequately compensated? The alt funding surface area that I just alluded to is much wider. It's less arbitrage because there are less balance sheets that are actively working in those markets, and it's structurally growing. If you just look at Hyperliquid's growth, if you look at the daily traded volumes, even during this bear market, combined across kind of all of these perpetuals, we're doing $20 billion, $15 to $20 billion a day. And that's where Unity is structurally positioned to take advantage of. And so as perpetuals expand to commodities, to equities, to tokenized stocks, to every other form of financial asset, Unity is there to be able to monetize that expanded funding surface in that area. There are real costs. So just to cover out on the last point on the risks, liquidity, as Philippe mentioned, alt perp books are thinner. So entry and exits, they have more price impact. We mitigate by sizing everything against what the open interest and the volume is for the asset on the venue. Execution, there's more legs to manage, right? Because you're running a much broader book, a much bigger book across more venues. There can be more slippage as a result. And so it just requires operational diligence and desk competence ultimately. And then last but not least, counterparty, right? So a lot of these kind of emerging perpetual products, they pop up on venues that might be further outside the scope of a traditional underwriter. And so as a result, we do an extensive amount of due diligence. We do a lot of testing before we start to ultimately move the book into those positions. So it fundamentally comes down to operational discipline at the end of the day.
Yeah, it seems that there's a lot of different layers involved in terms of on the management side, what you need to do. And so I guess a quick follow-up question for you, David, would be like, at what point would you say diversification actually adds complexity rather than reducing risk?
It's a question of the funding rate fundamentally, right? And so we look at it the same way that our institutional counterparties look at it, right? Which is, are we being adequately compensated for the book, the execution, and the management complexity? And to be fair, there are funding rates that are well over triple digits, but because of the slippage, because of the execution cost, because of the exotic nature of the venue, it's just simply not worth it. To your point, Jackson, to go. So the answer isn't kind of carte blanche. I wish I could just say, hey, here's exactly how we do it, but we look at it on a funding rate by funding rate basis. We do extensive testing. We put it on trades with house money, our own capital, and then we ultimately elevate it into the proper book.
Yeah, no, thank you for that. And so now going to Philippe, I want to touch back on the topic of when high APY is a potential warning. And so, Philippe, lending markets present an interesting challenge because a rising APY can mean healthier borrower demand, but it can also mean trapped liquidity or market stress. How does Avangard distinguish between the two before increasing exposure?
I mean, comes down to due diligence, right? So we look at each market individually. The borrow rate is just a formula, right? So it is a formula. It could be either lending supply that is going away, or there is more borrow demand. So if you look just purely at the APY and you base your decisions on that figure, that can come back and haunt you. So you need to understand how the liquidity is structured, what the market has been doing over the last few months, whether the stress the stress situation that is currently putting tension on this APY is correlated to the assets, the collateral, the market that you're in, or if it's a wider market stress. We could see that in the Kelp DAO, the RS ETH exploit recently, where liquidity grew thin very, very quickly on all markets across the board. But stress scenarios are not always a no-go zone, right? So sometimes you're paying to take on risk that is not specifically tied to that market, to that asset. So it's really about understanding the mechanics, understanding the markets, and being able to separate noise from signals, and make the right decisions at the right moment in time, which is what we are heavily focusing on.
Yeah, and Philippe, obviously, like pre-1010, when you talk about like noise and signal, there was a lot of that, right? Like everyone was looping. There were some insane yield opportunities, but obviously they weren't sustainable. So I'm just curious, in your shoes, like during that time period, were you looking at the market as an opportunity, or were you almost essentially just walking away from all of these higher yield opportunities, seeing it as basically a red flag?
I wasn't in the team at the time, right? So I cannot explain exactly what happened, but I do know that 1010 did hit everyone really, really quickly. So and I tried to explain it, right? So a stress situation like this was extreme, right? So 1010 happens once it's one of those black swan events, which is difficult to foresee. But in other situations, you just, if it is uncorrelated, then there might be an opportunity, but it really depends on the case by case basis how the team, the AM team, looks at the risk reward profile of a specific trade and whether we go into it or not. So sorry, I cannot give you the exact response to that event, but yeah, it could. It really depends on the scenario.
Yeah, no, thank you for that insight. Appreciate it.
Jackson, I wanted to add
go ahead, Mike,
into what Philippe mentioned about yield. I mean, there is a scenario where if a protocol is starting out and you have a large reward budget, but the assets are not large enough yet, then you might have an elevated APY, right? But as you scale, then the idea is, can you sustain that budget of rewards into the future, right? As you scale, right? So I just wanted to mention that back to what Philippe said, because I agree. It's a function of what you have to pay and what you can get, and at the end of the day, someone's paying the cost. Like the government is paying the interest to the U.S. Treasuries, fees to enter and exit, slippage. Like it's not, you can't like make, you can't just fabricate it in a sense, right? In open finance, I'm sure David and Philippe would know this because we always refer to DeFi summer, where the experimentation began, right? And there is a notion of using inflation as a mechanism, a token inflation, to provide rewards. But that's also not free. I think David mentioned something earlier in the call. You need the capital to actually execute this strategy, right? So in order to have this type of reward budget coming from, say, a token emission, you would need to be able to own an asset that allows you to get that token emission, right? So yeah, it's one of those interesting things that I think RAC differentiates our project from other real world assets, is that we are plugging into an existing decentralized ecosystem, like the Curve Finance decentralized exchange ecosystem, and tapping into that revenue emission that is set programmatically for the future. And again, if you can grow the system, you can have a sustainable amount at a certain asset level.
Yeah. And so, now we're talking about how returns are generated, which is obviously always good. But I also want to flip the conversation and talk a little bit about how principal could potentially get lost. And so, David, let's talk about like stress testing Unity, right? So during 1010, don't want to keep going back to 1010, but it's just a very specific event. Unity reported a maximum drawdown of approximately 0.39%, which is actually really impressive. So what specifically protected the portfolio during an event like that?
So just to talk about that number a little bit, 1010, it was by many accounts the largest liquidation event in crypto history on a notional dollar basis. Our portfolio, as it were, is exposed to those funding rates and the movement of those underlying assets, and our entire portfolio level mark to mark at the worst moment intraday was 39 basis points. We fully recovered within hours. So by the end of 1010, we were net positive again. And so really the impact was the yield profile. However, I very much consider us an outlier in that category, because if you look at a lot of our competitors during the same period, $100 million goose eggs that showed up inside of their NAV was not uncommon. And that's what led to a lot of the follow-on contagion across DeFi, across other liquid funds, so on and so forth. And what protected it, right? It's not that we're unique or special in any particular way. We did the boring things, right? We used minimal leverage. We position sized correctly against the open interest and the volume for the assets. We had cross-venue price checking, and then all of our collateral is largely kept off exchange. And so we minimized the counterparty risk, and we didn't try and shoot for a 40% APY with max leverage, because when ADL happens, the exchange machines, they typically weight you based on two inputs: how in the money you are and what your leverage is. And those two things are both directly correlated. And so if you're running a max levered long, carry trade, you're the first person to take the hit. And so we stayed disciplined. We stayed true to our risk parameters. And, we fortunately, everybody was very busy that day, but nothing really happened as far as we were concerned. And so that's what we want to bring to the market. And it's why we think the institutional underwriters that are starting to come into the space really value our approach, really value what we've set out, because it's something that they can get behind. It's something that they can underwrite. And again, these people, they're more suspicious of a 20, 30% APY number than they are of a credible 9, 10, 11 with a, now a year and a half track record behind them.
Yeah. I mean, at the time I was at a protocol that had about a 95% drawdown. So 0.39% is very impressive. So well done there.
I mean, Jackson too, if I could add, that's incredible, David. Congratulations. I think on that day, gold rallied, and I doubt real estate prices got impacted on that day. Right. Now, the whole point is most of open finance is really concentrated in crypto assets. Like, I mean, we were at your event, and tokenization is going to diversify the whole space, right? This whole notion of tokenizing assets is like a table stake now. Institutions are finding more avenues to do it. Speed of liquidity, the benefits, and I think as you see this growth, you're going to start diversifying open finance, right? And having different options to build, I think, better like portfolios, right? Because if you don't have the Lego pieces to build it, then you're just building a red car.
Yeah.
There's no different colors in a sense.
And Mike, sticking with you, so PMUSD is backed by tokenized gold reserves. So for institutions that are evaluating PMUSD, how should they think about the quality and reliability of that backing?
Yeah, it's really about the asset behind the collateral. Our partner has these reserves, and ultimately these are long-lived assets. They're in the ground reserves with all the reporting documentation supporting them. I mean, our partner carries a collateral ratio 5-to-1. So you have to have like 5 ounces of proven reserve to price it at one spot. So there's already like a 5-to-1 kind of coverage. Even if you look at industry standards, because you can go and look at the other big gold producers out there, and they have both assets, right? They have above ground gold, but they also have like in-ground gold reserves. And there are valuation metrics to price that. And it's really very standard to be that kind of 5-to-1.
Yeah. And then I also want to jump to Philippe. In terms of Avantgarde's vaults, they use pre-approved on-chain permissions. And so the question for you is, how do you translate an institutional investment mandate into enforceable limits around collateral, leverage, liquidity, and concentration, while still giving a manager enough discretion to react to changing markets?
Yes. So the answer is a bit more technical here. So we are using smart contracts, which are right now called Zodiac roles, meaning that we are giving each person involved in the management, in the mandate, a specific task that they can or cannot do, right? So the roles are separated. The bands are actually set from the get-go, right? So the mandate says you can only deploy 40% into these type of markets, 30% into these, and the bands are set programmatically. So our team can never enforce going, bit deeper into that position, because the smart contracts impedes us from doing so. So it's really it's the way that we're currently running some strategies, the on-chain option strategies. It's been validated by Open Zeppelin on the Compound DAO forum as a way to do it in a non-custodial way and with all the security safeguards around it. So this is really, we're in general, when you do this in TradFi, you have an audit coming after you post the results. People come, they audit you, but here we just limit it from the get-go. We decide what we can do, how we can do it, and we cannot go beyond that.
So to kind of like go further on that, what risk controls should be hard-coded versus which one should be left to human discretion?
I mean, the allocation size, so it depends on the risk profile of the counterparty, of the client, right? So how risky should this strategy be? What do they want to deploy into? So the type of assets, the type of markets that we deploy into is very critical, right? So it's not our client base, which have been DAO treasuries, are very, very conservative in general. So going into maybe pendle markets that are very high yield, but not a bit less secure, will not be included in the strategy, for instance, right? So we just say we want Bitcoin-based, Bitcoin collateral-based lending markets, because Bitcoin is still the number one asset in those markets, and the most liquid one. So most of the capital goes into those type of markets, and then we increase the risk profile of the rest of the allocation based on the decisions that the client gives us. And the risk, the Zodiac roles that we're using also gives the clients full control over us, right? So if they don't want us to continue executing, they can just pull the plug programmatically on their end and say, look, we withdrew all the permissions. This is not moving forward. So that's also kind of a safeguard for them, knowing that they are in control at all times and that it's handled in a non-custodial way.
Yeah, and I'm sure.
Jackson,
Go ahead, Mike.
Really hard, right? Like what Philippe and his team and David is like. This is advanced financial stuff, and so there's like two layers. It's like you have to have a product that provides a return budget, but you're not going to have all your assets, especially if you're a large fund. You need to have diversification. You need to have different types of strategies, and you need to have it in a way that it's risk mitigated, and that's really hard. And the second layer is putting that together. So you have to have the ability to produce yield, and then you have to be able to put functional portfolios together, and that is its own job. That's really hard, and I think that's where you're seeing a lot of the growth and curation come up, where you're having these sophisticated teams be able to do this for individuals at size. So I'm optimistic, because I think this is hard, and I think there are projects, teams, individuals that can provide that kind of solution for open finance participants.
Yeah. And now to kind of keep this moving along, I want to jump to an important topic, which is liquidity, because yield only matters if investors can actually access their capital when they need it. So not just under normal conditions, but under stress. So jumping back to David, UTY uses a 7-day redemption process alongside an on-chain liquidity buffer. So how is that buffer sized, and what happens operationally if redemption requests exceed it?
So a little bit about the design philosophy behind why 7-day. It exists as a window to do two things. First of which is it provides a sufficient time for us to respond to an alert, an anomaly, some unpredicted condition in the market. So that's part one. The other is that it's also the window in which an orderly desk unwind can occur. And so when a large redemption comes in, we're not subject to fire sale prices, highest slippage, highest risk, highest concentration, whatever the on-demand prices. We can obviously mitigate that. We can spread orders out over that 7-day period. Mechanically, so the yield-bearing variant redeems instantly into the dollar variant, or the dollar referenced variant. And so Unity into dollars, functionally leaving the protocol, is what carries that 7-day bonding period. Small redemptions can be processed from the vault on chain instantaneously, but it's the larger ones that are ultimately get funded ahead of maturity. So that period, that buffer, is what allows everything to process in a orderly fashion without impacting the total portfolio like return profile.
I was gonna say, do you think it's unsustainable for protocols to offer instant liquidity, just given that there's a lot of factors that have to come in when processing a redemption?
No. I mean, this is fundamentally, this is not uncharted territory or exotic, financial engineering. This is something that most portfolio managers think about, or fund managers think about when they launch their strategy. What are the constraints of the strategies and vehicles that you're deploying into, and then can I use other layers like a carry trade or some other form of basis that allows me to do quarterly redemptions or a weekly sleeve or some other variant that maps to what your clientele is looking for. And so do I think it's an issue? Only when you have a mismatch between liabilities and assets, or a liquidity mismatch between the two. That's when the issues obviously arise. But no, like if you have built your portfolio correctly and you are able to service that redemption window, then on-demand liquidity seems perfectly reasonable.
Definitely. And so, staying on the topic of liquidity, Mike, real estate is inherently illiquid, which raises an important distinction around tokenization. So does tokenization actually create meaningful liquidity, or does it primarily improve access and transferability to an asset that remains fundamentally illiquid?
Yeah, your latter, you nailed it, Jackson. Well done. But then I also think it opens up the ability of composability. I mean, that's a technical term that is thrown around in open finance that doesn't really get thrown around in traditional finance. But it's a hidden advantage. It's the ability to use an asset that is productive. Like in our case, these rental units are paying income. They have a value. It sits there dormant. But then now we can, if we tokenize it, we can liquefy that value. We can always, if we have to redeem a property, there is a redemption mechanism for our real estate token where you would just, the on-chain existence would disappear to unlock the real world asset for liquefaction. And you have to think that there is an element of maintenance, disposition, improving your portfolio in a sense. So for sure, there is that ability, and we think that it's the composability to be able to take this real estate token and then like borrow against it adds a huge amount of financial flexibility for the participant. I always akin it back to Jackson, and I'm sure Philippe and David might have views here, but if you own like a stock, you as a shareholder get to vote, but there's no way for like there's no reward for voting in a sense. But the fact that open finance has incentivized or really opened up that quote unquote the power to the user from voting, it unlocks, and there's a composability where you have a dual presence. You can earn and then exercise whether you want or not your voting right? So yeah.
Yeah, no, thank you for that explanation. We have about 8 minutes left, so I want to ask one more question for Philippe, and then I have a final question I'm going to open up to everyone. But Philippe, so Avantgarde offers both public vaults and bespoke non-custodial separately managed accounts. So my question is, what determines which structure is appropriate for an institution?
I mean, probably the most important aspect is that pooled products are not easily easily risk assessed, right? So if you go into a public vault, you pretty much enter uncharted territories. You don't know who all the counterparties are. So institutions would rather go in, a vault route and an SMA route where they can control everything. They can control the liquidity. They can control the results, and they define a very specific strategy. So what I was saying before, let's say we want to propose a looping strategy on RWAs. That might not be accepted by everyone, right? So, but a very specific client mandates this. So we can set the parameters of maximum leverage. We can give a full reporting on the specific vault itself, which is very important to institutions, right? So because they have their monitoring and reporting duties as well to their own LPs and allocators. So making it through a vault is usually the way to go. And then as soon as we and I want to go back on what Mike said, right? So because RWAs are becoming increasingly interesting in the space, it's been growing and growing. I think we're almost hitting 40 billion in tokenized RWAs. We're around 38 billion right now. The lending market have grown 700% over the last year to date, not over the last year. So there are lots of opportunities coming up, but RWAs come with RWA constraints, right? So you have to do a KYC, KYB. Not everyone can enter and access those assets. So if we want to have elaborate strategies with RWAs which are not available, to retail, then going down an SMA is usually easier because the open vaults don't allow us, from a licensing perspective. And you could do retail, but that's not the type of license that we hold, and it's easier to handle just the B2B aspect on a KYB basis for a specific mandate. So yeah, it's usually depends on the client.
Yeah, 100%. And so while we have a few minutes left, want to kind of jump to looking into the future. So question for all of you, and would love to hear all of your perspectives and takes here. So let's say the year is 2030 and on-chain yield has become a mainstream institutional allocation. What would you say has happened between now and then that made institutions finally say, okay, we're comfortable putting serious capital here?
I would say the kind of thing that's front and center for us and top of mind is standardized disclosure as the opening that allows us to say, plant the flag and say institutions are on chain, right? Because right now, we talked about it before, we haven't done a great job as an industry like defining standards, because every number is self-defined. Case in point, a uniform APY definition would be phenomenal, right? So that you could actually compare across platforms, across vaults, across yield providers. Is it trailing versus spot, gross versus net of incentives, over what time window? Because two products quoting 10% could be materially different risks, could be materially different yield streams, could be materially different exposures. And it's just, you have to be a full-time practitioner just to compare two products, let alone the thousands of opportunities that exist there today, right? Second, if we moved from proof of attestation, which I think is a great first step in the right direction, to proof of solvency, which is what underwriters actually care about. It's not that, oh, there's assets here. It's that custody is done in the correct way, that funds are held in a bankruptcy remote account, that can those funds ever touch the exchange? Who's in control of the keys? And by the way, everything that I've just outlined doesn't actually require new law. It just requires us to be uniform about the definitions and the way in which we do due diligence and the way in which we evaluate these protocols. The same way that hedge funds converge on standardizing due diligence. And the products that actually have every incentive to adopt them first, because commoditized disclosure is a subsidy who has nothing to hide, right? And so if we can align on what that underwriting process is, I think you'll see, the high quality streams that we've been talking about across this webinar ultimately rise to the top.
Yeah, 100%. Mike or Philippe, you guys have anything to add to that?
Yeah, I would say I hope what David just said happens. I think it would be amazing. Standards, risk standards are super important. I'm going to take a bit of a half, like a full cup. I think we're going to see liquidity grow, but more on the stable side. So I think that's really good news for David and Philippe's businesses, because I think stable tokens has to occupy a larger total asset share of crypto. It's too lopsided right now. There's too much risk assets. There's not enough stable collateral assets, uncorrelated assets. Like foreign exchange, you could triple stable token by just including the other two most popular currencies in the world, JPY and Euro. And again, I'm just, you're asking to think down the road, but I think David's standards of risk measurement would be a huge improvement. But yeah, liquidity. I think we need to keep working on liquidity.
100%. And Philippe, anything else you want to throw in there?
I mean, on the and back to the RWA side, right? So currently, institutions can buy RWAs the way they want. They don't need the blockchain for it, right? So the incentives to come on chain need to be very clear, and there is also kind of a push that already happened probably 10 years ago when we had those consortia of large companies that built Hedera, or now we see Canton that is kind of building a siloed blockchain, which is not fully transparent, so it doesn't have the attributes of the open finance, the open blockchain, and decentralized traits that we promote and that we cherish. That is also showing that institutions are not fully on board with all of the openness of the blockchain. Just because I see those trends in that direction. So, what is the benefit for institutions to come and to tap into on-chain yield? Because RWAs, they can get off-chain easily. Are the margins, can they improve on their margins, right? So can strategies on the blockchain improve their books? And this will be, if we see public blockchain adoption increasing, and not specifically only the private networks that are currently being built and that have been built, but I haven't seen the real results from there. Then we might be in a better place. But they need to feel comfortable with open systems.
Yeah. All right, guys. Well, that puts us at time, but this was a great conversation. So really thank you all for joining. You're all building, tremendous products that are going to help push more and more capital on chain and, drive sustainable yield. So thank you so much for joining the discussion today, providing all these great insights. And definitely look forward to, having future discussions around this.
All right. Thanks a lot for inviting us. Thank you, David. Thank you, Philippe. Cheers.
Good talking, guys.
Have a good day. Bye-bye.
Thank you.
Woo!